Hello and welcome to this brand new video where we analyze a couple of strategies from our portfolio that are performing very well. Today in particular, we will focus on the soybeans market, a very interesting and highly liquid future, which can be approached with various strategies and time horizons, both intraday and multi-day. Let's now take a look at the first strategy I want to show you today. This is an intraday breakout system that uses a 5-minute time frame for data 1 and a time frame of 1440 minutes for data 2. The system opens new trades on breaking the previous day's lows. I'm only talking about lows because this system trades only on the short side, meaning it only opens short positions and doesn't enter long positions. Going back to the system rules, we mentioned that the strategy, once prices have broken the previous day's lows, enter the market and holds the trade open until the end of the day, unless a profit target or stop loss is reached earlier. As we can see from this image, where this trade is triggered by a breakout of the previous day's lows and then is carried into profit until the end of the day. This is supplemented by filters related to the trend and volatility, including our pattern libraries. If we take a look at the metrics, we will see that the system has earned, since 2010, approximately $75,000, with a maximum drawdown of only $5,175, which is a notably low drawdown. As for the distribution of profits over the years, we see that except for 2010, when we closed the year at a loss, for the rest of the period, all years are profitable. Let's also take a look at the overall average trade, which turns out to be about $134 distributed over 561 trades. This is sufficient to cover live trading costs, including commission fees and slippage, considering also that this is an intraday system. Finally, let's also take a look at the equity line, which is very nice and regular, considering also the metrics we saw earlier. Let's now move on to the second strategy. This is a bias type strategy, and in this case too, we trade only on one side. In this case, it's the long side, and we work on a 5-minute time frame. Coming to the rules of the second strategy, it exploits a reoccurring overnight price bias of the underlying asset, the soybean future, and in particular, it's a bias that occurs over the weekend. According to the rules, the strategy will open a long trade on Friday at the end of the session and will close it at the beginning of the week when the market opens again. Obviously, if we didn't put any filter and didn't limit the strategy in any way, it would open a new trade every week on Friday. That's exactly why we've introduced some filters to basically extrapolate the best trades. But let's dive into the system's metrics. The strategy has earned about $61,500 since 2010, with a really very low maximum drawdown of $3,375. Also, the distribution of profits over the various years is very regular and always positive, except for 2015. As usual, let's also take a look at the average trade of the strategy, which almost reaches $165, an extremely high value for the soybean futures. Finally, let's also take a look at the equity curve of the strategy, which, as we imagined seeing the excellent metrics, turns out to be very nice and extremely regular. So we have also seen this second strategy, and I would say that's all for today. If you're interested in systematic trading and learning how to develop strategies like the ones we've explored today, click on the link in the description of this video. From there, you can access a free presentation by Unger, get a copy of our best-selling book, The Unger Method, for just the cost of shipping, or schedule a free strategic consultation with our team. Thank you for watching, and I look forward to seeing you on our next video. Bye-bye for now.